I'm going to stop the recording for a minute. Okay.
All right. Good morning, everybody. Welcome. My name is John Yakub. I'm your 2022 Tri-Counties Association of Realtors President, and I want to welcome you. We're very pleased to see you at our economic forecast and legislative update. Just a few things we need to cover first. We're going to be recording this event and it's going to be available later on our website, our YouTube channel, sometime next week. So if you have any questions for our speakers, please type them in to the Q&A section. That's the Q&A button at the bottom of your screen on most Zoom updates. Type in your question and Laura will field those questions to our wonderful speakers at the end of their presentation. All right, and we've got a lot to cover today, so let's get started. Jordan Levine is the Vice President and Chief Economist at the CAR Association, as you may know, a statewide trade organization of real estate professionals with more than 200,000 members. Now, Jordan is responsible for CAR's housing market and economic research, as well as the policy analysis for CAR's legislative and government affairs efforts. He has a passion for home ownership, is actively involved in the company's diversity, equity, and inclusion initiatives, and he regularly represents CAR to its members, the real estate industry, policymakers, and in the local national media, you know, all the big wigs. And Jordan has a bachelor's degree in economics from UC Santa Barbara and a master's degree with merit in international economics from the University of Sussex. So, and prior to joining CAR, Jordan worked in a consulting firm as an economist and director of economic research, where he oversaw all the research and economic analysis on California's economy and housing market. And he's regularly spoken to trade groups, public officials, businesses, and the media. So all this to say, he's a big deal. We love to have him with us. So Jordan, enough of me, take it away.
Thank you, John and Laura, for having me. And thank you for reading that whole bio. It very
You're
much
welcome.
Reminds me to have Paula pare that thing back before the next one. So
There you go.
I'm gonna share some slides. You guys are my guinea pigs because this is the first outreach since the Fed raised rates yesterday. So we can talk a little bit about what the implications are, although I think it's mostly a non-story in some ways because it was so widely broadcast and expected. But you know, we still are fairly optimistic about the trajectory of that broader macro economy, even as the Fed starts to really try and grapple with rising inflation and you know, all of the kind of crazy geopolitical stuff that's kind of driving bond markets nuts right now as well. But so far, and we don't get a ton of data on a weekly or daily basis, but the data that we do get continues to improve even with this recent turmoil, right? Things like unemployment insurance claims. The recent jobs report that we got from California showed upward revisions. So people are getting back to work, incomes continue to go up. And you know, broader kind of measures of business activity, whether it's GDP or consumer spending, what have you, all continue to move in the right direction. And of course, housing in particular continues to do well. I would say, you know, potentially remarkably well in the context of rates that have already risen pretty dramatically from where we started in 2021. We were at all-time lows back in January of 2021, and they're still very, very low by historical standards, but we have seen them creep up. And yet, you know, weekly measures of transactions, if you look at things like market competitiveness, they all remain very strong despite the challenges. I would be doing you a disservice, though, if we didn't zoom in and talk a little bit about some of those challenges, not because I think it disrupts the whole economic forecast that we need to start getting into a kind of belt tightening, hunker down mode, but because I think it really means that we need to have a kind of nose to the grindstone approach, even as the macro environment will probably continue to improve. Because on the one hand, we have these kind of cyclical and wild card issues, the inflation, the increase in rates, right? All of this is happening against a backdrop of an industry that's changing pretty dramatically, whether it's with, you know, iBuying or portals and all the stuff that's happening with the MLS and NAR and the Department of Justice and all of that stuff. And on top of that, now we have what I would call an acceleration of our structural challenges, those kind of pre-existing conditions that we had as a state before this crisis, I think are even more acute now that folks can work from home, that they can, move out to Big Bear and maintain access to the high paying job and what have you. And this all really comes down to supply, which is why I'm so glad to be able to do this event with Sanjay, because a lot of this stuff's going to happen, at that front, and trying to kill off stuff that's preventing supply from coming online. And that's really where the rubber meets the road, because if you just look at the broad trends, there's not a lot of reason for optimism, right? That this doesn't seem to be solving itself. And I think that's true both in terms of the housing turnover, which is the number of homes that we see on the MLS, obviously, but which is, a symptom of a deeper issue, which is this lack of new development that's been persisting for decades, right? And I know there's this kind of brother-in-law effect that I keep hearing about, especially as rates start to rise and the Fed gets more aggressive, that we just need to wait, and there's going to be a bunch of REOs and prices are going to go down and everybody's going to save a boatload of money, and there's going to be all these options to choose from. But if you actually look at the data, it doesn't seem like distressed units are going to come in to save the day on the inventory front, which is a good thing for those homeowners. It means they're going to be able to hang on to most of those homes, but it also means then that the supply challenges that we've continued to face are going to persist this year. And so when you put it all together, I think that yes, the outlook remains positive, and we haven't dramatically revised our forecast because of higher rates or because of the war that's happening in Eastern Europe right now. But at the same time, even as we think that things will continue to improve despite those headwinds, at the kind of individual realtor level, we need to be very much in a kind of foot on the accelerator type of mentality, right? Because we have a lot of work to do with our clients and taking a kind of data-driven approach and, talking people down from the ledge and overcoming that brother-in-law effect that's out there, and getting folks really focused on the true benefits of home ownership and the fact that rates and prices are probably going to continue to rise. And we also need to get serious again when it comes to our kind of influence out there, right? And making sure that we're starting to tackle some of these longer term challenges so that the future remains kind of optimistic here in California. So why do I throw the wet blanket on right at the beginning? Is because I want to manage your expectations. Because if you start to walk through some of this macro data, which I'll show you just a handful of indicators, both because I want to make sure I'm justifying that student loan, but also because, the kind of 30,000 foot trends are the things that really drive demand for housing and things like that, right? And when you look at that data, again, it's all moving in the right direction. On Friday, we just got updated employment figures from the state employment development department. So every year they go through an annual benchmarking process where they kind of tighten up the survey data to actual payroll records that come in from folks filing unemployment insurance. And the bottom line to that story is that the recovery has been stronger than that, what had originally been reported. So the data in the light blue here is what the employment trend that we were seeing all through last year based on the 2020 benchmark. And when they came out with the updated revisions on Friday, you can see that the blue line is a lot higher, right? That we've added back more jobs even than what we had originally thought. So not only have we been on this kind of consistent upward trend since the initial shock to the economy back in 2020, but again, it's actually grown at a faster pace. And you can see here that when we compare annual growth rates, right, that 2022 benchmark, excuse me, jobs didn't fall quite as much at the end of 2020 in particular, and they grew much faster in 2021 than what we originally reported. So at the end of last year, this was the story I was telling you, right? 2.7 million job losses. We had added back about 1.9 million of those jobs. So we still had about 750,000 to go to get back to pre-crisis levels. Here's what that story looks like now. The job losses were a little bit more steep. We lost 2.8 instead of 2.7. But again, with that stronger recovery, we're now less than 500,000 jobs shy of that pre-crisis level. And to me, what's even more encouraging than the kind of magnitude of these increases, right? It's not just that we've added back 2.3 of those 2.8 million lost jobs. for me, it's encouraging that that's been really consistent, right? That even with all the ups and downs in the economy, and we open up and we close back down, and we're masking and peds and all this stuff, and then we're not, even, all of that stuff happening in the background, the jobs numbers have been really increasing at a fairly consistent basis, which tells me that we've really got our arms wrapped around how to do this, right? How to operate in a kind of pandemic environment. And even as, we're not kind of totally out of the woods yet, there's that's becoming less and less of a kind of headwind, especially as the numbers themselves have dramatically improved on the public health front. So jobs numbers are looking good, right? The other thing is it's also an area where we've started to outperform the rest of the United States. So I showed you how the recovery was stronger than what they were telling us before, but here's our recovery compared to the US recovery. And you can see that it only took a couple of months once jobs started growing for California to kind of resume its spot at the forefront of economic growth nationwide. So it's not just an area where we're improving, it's an area where we're now punching above our weight, as it were. And again, I think that this is a sign that we, unfortunately for the newspaper industry, right, can't write California's obituary quite yet, right? Even with all of our business unfriendliness and, hostility and high taxes and all of that stuff, we still remain an economic success story. We just had a bigger hole to climb out of, but we're clawing our way back faster now than most other parts of the nation. If you look at, not just the consistency of the improvement, but how broad-based it was, right? These are sorted from the most affected regions on the left to the least affected by job losses on the right. But even those very resort-heavy markets, your Napas, your Sonomas, your San Luis Obispos, where I live, where a huge chunk of the local economy is dedicated to bars, restaurants, hotels, all that kind of tourism stuff, which really bore the brunt of this crisis. Even in those areas, we're still fairly consistent with that statewide 82% recovery. More or less, we're somewhere between 65 and 85, 90% of the way towards full recovery, with a couple of markets, including the Inland Empire, and parts of the Central Valley that are already above pre-crisis levels, that have already fully recovered and are now punching above to new all-time high levels of employment. You can see the same story if you look across industries, right? Those industries on the left that were most heavily affected: retail, leisure and hospitality, other services, which is where we go to, drop off our dry cleaning, get our hair cut, all that kind of personal care service stuff. Even in those sectors, you're seeing, broad-based recovery. And so, again, we're moving in the right direction. We're doing so on a consistent basis, faster than other places. And we're not just hanging our hat on one particular geography. And it's not just the tech sector, although that is one of the industries that's back above, way above pre-crisis levels. Logistics, I actually had to chop this chart off at 130%, because logistics is almost 200% of where it was before this crisis. We're buying a lot of stuff at home on our couch and sweatpants, and that shows up in these numbers. But if I would have showed you the logistics, then everything else would have been smashed down. You couldn't see it just because we're buying so much stuff online. But the bottom line here is that, again, we're improving across the board, whether we're talking about geography or industry or income level or good jobs, bad jobs, all of that stuff. They're all kind of on the increase. And you can see we've had a dramatic improvement even in our unemployment rate, which is now in the mid single digits after rising to, 16, a little bit over 16% during that initial impact. The only other thing I would say about the macro economy too is not just the jobs numbers. And I chose those because that's the most real, that's where the rubber meets the road. When you're working, then you can borrow and buy a house and all of that stuff, but it's reflective of other economic trends, but also on the financial side of the economy, right? And what I'm showing you here is the Federal Reserve's financial obligations ratio. That's the percentage of debt and broader financial obligations, debt and other stuff, as a percentage of current income. And one of the really, kind of silver linings, I think, as difficult as the 2008 financial crisis was, is that it really forced households to get their kind of, financial house in order, as it were, right? That it was a painful process, a lot of REOs, a lot of bankruptcies, a lot of people, got NODs and got cars repoed and all of that kind of stuff. But, the flip side was that we got rid of a lot of that unsustainable debt, that was kind of characterized by, really loose borrowing and lending standards out there. And we didn't just fall to kind of pre-housing bubble levels, right? Those numbers were at the lowest levels since the Fed's been recording this data back in the late 1970s. And so, we weren't kind of back against the wall financially waiting for, an economic shock to happen to just get that snowball rolling on much deeper fundamental challenges like we were back in 2006. You could also see this just in terms of like savings rates, right? If you go back to 2004-5 timeframe, savings rates, and this is as a percent of disposable income. Actually, if you looked at just as a percent of aggregate income, savings rates were like basically zero, right? That your savings rate, just your savings account became this thing that maybe your grandma put money into on your birthday. But other than that, we forgot what those were. Those numbers trended up consistently as well. So we weren't racked with debt, and we had a little bit more financial cushion to be able to withstand a shock. And then of course you can see what happens when Uncle Sam started depositing money in our savings accounts as well. Those numbers shot up through the roof. But even before that, we were looking at 7-8% savings coming into this crisis. So we were in a much better place to be able to withstand a shock. It was unprecedented, and those job losses that I showed you were the biggest and fastest that we've ever seen. But it was a shock that was happening to what was otherwise a relatively healthy economy, much different scenario than we were in 2006. So we've got that kind of economic tailwind at our back, and even though it's been muted somewhat by rising rates and geopolitical tensions, it's the forecast is still for things to continue to improve. But we've also got this structural change in kind of the importance of home, right? That we're asking our homes to now check so many more boxes for us than we did in the past, right? You need that outdoor space. You need a place to work from home. You need to be able to homeschool your kids, and all of these things really resulted in this kind of insatiable almost appetite for housing. And we had this kind of counter cyclical response. Usually when the economy goes down, housing goes down as well, right? But this time, again, because of that, change in what we were asking our homes to do for us, you saw that the economy went down and housing shot through the roof. And we actually have had 2 years in a row now with elevated levels of the market getting gobbled up by first-time home buyers, right? Even with all of the challenges, a lot of these kind of high-income, long-term renters finally had that motivation, along with, being relatively insulated from the crisis. They could do their jobs from home. They didn't have to go to the office, pay for parking, do all that commuting, et cetera. All of these things kind of combined to, again, get a lot of these folks to get their foot on that property ladder for the first time. And even though we came down a little bit last year, we were coming down from a 10-year high in 2020. And again, we were still at an elevated share of first-time home buyers. The census data is incredibly lagged. We just got in January the 2020 numbers, right? But when you crunch those, it corroborates what the realtors told us in our survey about their clients, right? That a lot of these were indeed first-time home buyers, and we had an actual, statistically significant increase in home ownership for the first time in several years as well. And again, that's even, amidst rising prices and all of that stuff, which again, I think is just a testament to that renewed passion for home ownership that we see out there. I didn't bring the chart, but this was also really broad-based across every race and ethnic group last year, which is again, something that hasn't been the case. We still got a lot of work to do, but at least those numbers have started to move in the right direction. But when you put those two factors together, right, the fact that those high income earners were protected from the effects of the crisis, that rates fell to all-time lows, that we could work from home, all of this stuff led to a housing market last year that was the strongest we've seen in over a decade, going back to 2009. We had almost 445,000 transactions, and that's, in a context of a housing market that really struggled to maintain a 400,000 unit average for the better part of the last decade leading up to COVID, right? And so this wasn't just good compared to the pandemic numbers, right? These are good objectively relative to anywhere we've been in the last decade. The other thing that's encouraging, I think, especially to folks on this call, is that unlike 2020, where we saw a lot of out migration to places like Big Bear and Tahoe and Mammoth, and people really taking advantage of remote work, last year the growth was concentrated in the Bay Area, Southern California, and to a lesser extent in the Central Coast. We started to see that kind of homegrown housing demand reassert itself, right? There was still out migration, and I'll talk about that kind of acceleration of long-term challenges, but we also still have a lot of folks and jobs and job growth, et cetera, in the kind of core. And one of the things that we saw in particular, again, kind of through the lens of folks on this call, is that, a lot of that stuff started to happen along those traditional transit corridors, right? And I just picked out a smattering of local markets across the region, but you can see for the most part, with only a few exceptions, we were outperforming that broader statewide average of an 8% increase last year, which again, I think is just kind of speaks to this renewed buyer demand, again, in those kind of traditional employment centers, population centers, and transit corridors, et cetera, right? And this all happened even as prices shot to new all-time high levels. This is an annual number, but during the summer last year, we were up somewhere around 830,000. And you can see how far we've pulled away from home prices in the rest of the United States, now more than double what you pay elsewhere. And this was a chart that really shocked me when you just kind of look out at median prices and parts of Southern California that have traditionally been more affordable than living in like the West Side or Santa Monica, right? You're talking about, you're hard pressed to find stuff under $750,000 pretty much across the board. And so again, just speaks to the strength of that buyer demand that continues to just push up those home prices. And even with the recent uptick in rates and all of that stuff, you can see that the first 9 or so weeks of this year haven't fallen off a cliff, right? We're not posting incredible growth necessarily compared to where we were last year, but I would say that given how high rates have gone, how quickly, that the market is doing well to maintain above a 400,000 momentum. We are starting to see some of that give back, right? So we are moderating down from those 15-year highs, and you can see after posting double-digit gains last year, the Bay Area and Southern California are down by double digits essentially through the first 2 months of this year, but that's moderating back down to like 2020 levels, right? Which, as I showed you, were above the pre-pandemic standard. So we're coming down from those 15-year highs, but we're coming down to levels that are still kind of above the 10-year average. So we're just not able to maintain the momentum, and that I largely attribute to housing supply, which we'll talk about here in a second. But you can kind of see the same thing happening in the local market, right? I'm showing you those growth rates from last year that I already showed you compared to the growth rates for this year. And I don't know what happened to my legend, but the blue stuff is this year, right? But you can see that same kind of moderation, big double-digit gains last year. In some cases, given most of that back this year, although in some places like Covina and stuff, they continue to grow, even though the broader market has started to moderate. And again, I think that a lot of this moderation comes down not to buyer demand, not to interest rates, right, but to supply. Because if you look at the percentage of homes that are selling above asking price this year, the market's already through February more competitive than it was in 2021, right? And so if this was a demand issue, the market wouldn't be getting more competitive, right? You would see a little bit of easing of pressure, and yet we're talking about 70-80% of transactions are still closing above asking price, and that's a little bit higher, again, than what we saw throughout last year, which was an incredibly hot market environment, right? Single digit, you're pretty much talking about a week from list to pending across the board, right? And this is just, this is a median too, right? So that means that 50% are going pending in less than 9 days in Claremont, which is just a kind of incredible testament, again, to this renewed passion for home ownership that we saw. And it's not just bidding up the prices. It's not just making homes sell quick and sell for more than what they're asking for. You also see that buyers are having to get increasingly creative to be able to get their offer accepted, waiving contingencies, right? Having no kind of, and I think that's one of the reasons why our hotline is so busy, right? Because these deals are becoming much more high stakes, as it were, right? When folks have to make their offer stand out from the crowd. Actually, we saw an increase in all cash buying last year, which kind of seems nuts in the context of a 2.65% interest rate, but that's, again, another way that you make your offer be the one to get accepted, right? And then the week you close, you go out and refi that out, and you don't want to use your own money, but unfortunately, you've got to, again, make sure that you're your offer is the one to get accepted. What about all this stuff that's happening in the broader economy? Let's talk about, Russia and Ukraine and inflation, which is still running at a 40-year high. We got the February number the other day, and you can see that CPI growth is still running very, very hot. If you kind of break down the stimulus or the inflation number into the kind of sources of growth, we had this coming to us in some ways, right? This is base money supply, and you can see that the 2008 intervention, right, pales in comparison to the amount of money we threw at this crisis through, not just kind of selling treasuries, but going out and buying mortgage-backed securities and all of that stuff. Not the base money, the base money supply, and this is at the risk of getting way too technical, but it isn't the be all end all of inflation, because not all of the money that the Fed pumps in ends up in people's bank accounts. You can deconstruct that down into how much actually made it out into the money supply and how much was just there to backstop the financial system with excess reserves in case there was a run on banks and things like that. But actually, and if you do that exercise, you can see in 2008, it was really all about backstopping the financial system, right? That all of that monetary stimulus didn't really end up in people's bank accounts. Whereas this time around, you can actually see, even though a lot of it was backstopping, banks, there was a little bit of a kind of uptick in the slope of that blue stuff at the end, starting in 2020, right? And if you look at it on a year-to-year growth basis, and you look at, just that part that hit people's bank accounts, the currency, the checking accounts, right, the money markets and that stuff, you can see that we really did, a lot of that monetary stimulus showed up in people's bank accounts. Some of it was through, I guess we would call it monetarily financed fiscal spending, right? That we gave a bunch of stimulus checks and deficit spent and did it through, by financing those through treasuries and stuff like that. But, we did really put a lot of money into the system that resulted in folks going out and buying cars and buying boats and driving up all of these prices with all of this new money that they had in their bank accounts. And that's why the Fed already acted yesterday. We got the anticipated Fed rate hike. We're expecting 5 more or 6 more, which is actually a little bit less than what the pre-crisis timeline looked like. There was 8 potential rate hikes coming down the pike before, but that's what they're responding to, right? Is to try and undo some of this kind of heat that they pushed into the system to keep things going during COVID. What about all this geopolitical stuff? And I won't beat this to death, but I would say it's very much on the one hand, on the other hand, kind of a story, right? Because we've already seen, the impacts to inflation, energy prices when you fill up your car at the pump and stuff. And that is more inflationary. That's what the Fed's already hyper focused on responding to. That would suggest higher interest rates, right? But on the other hand, it depends on how long this goes on and whether the financial markets are really done and just on the upswing from here on out, or whether we continue to have volatility. Because if people feel less poor and don't spend as much and they don't want to go out and borrow with higher rates, then we might get less economic growth than what we had originally anticipated for this year. And that would suggest less pressure on inflation, less pressure on the Fed to continue to raise rates, especially as we're still that kind of cleanest dirty shirt in the hamper, if you will, for the rest of the world, where when things, get hot abroad, then people want to buy US treasuries as a kind of safe haven. And that means, less pressure on rates. When you got a lot of people wanting to buy bonds, you don't have to raise the rate quite as high. And you also have a dollar that should be appreciating and taking some of that pressure off of import prices, right? That our commodities, the labor that we import from the rest of the world, when we have a stronger dollar, we don't have to pay as many as big a price increases, because those folks are already making more money just by virtue of having us buy stuff with dollars. So ultimately, we might only see those 6 rate increases, not the 8. And the bottom line is we haven't dramatically revised our forecast, but rates are poised to continue to rise. And I think that is an important salient point for buyers out there, right? Who are waiting for prices to go down and all this inventory to just, spill onto the market, that, we're basically at where we were at before this crisis with about a 2-year 10-year, or a 2% 10-year treasury, right? Which is where we were more or less before this crisis, and about a 3.5% to 4% 30-year fixed rate mortgage. Thinking out over the medium term, right? If we get back and they're able to stabilize inflation around their kind of target, then we're looking at 10 years that are around 3, and 30-year fixed rate mortgages that are around 5, right? And every 50 basis points in interest rates costs home buyers about $200 a month, the median home buyer at least, about $200 a month. And so if we go from 4 to 5, you're talking about $400 a month more for the same exact home, right? And that's the median priced home of roughly 800,000. If you're in a higher price bracket, it goes up, concurrently. If you look at where they are relative to the Fed funds rate coming into yesterday, right? A lot of this was kind of already pricing in, trying to get ahead of the curve, right? Because the Fed funds rate hadn't changed, and we were already up at about a 4% mortgage interest rate. And again, a lot of this was anticipated. The financial markets saw this coming from a mile away, which I think is why the Dow's up several hundred points today. But if you look at the daily numbers, right, we got a Fed funds rate now that's about a half a basis point, or 50 basis points, excuse me, and it's really pushed up short-term rates in particular, right? And that, coupled with the short-run risk of all the stuff happening with Russia and Ukraine, the gap between 10-year and 2-year has gotten a lot lower. And this is where I don't envy the Fed, because they're having to walk the tightrope between, staving off 40-year high levels of inflation without pushing us into recession. And here, if you look at the yield curve, this is measuring that gap between 10-year bonds and 2-year. This is like an incredible indicator of recession, right? It's one of the few predictive indicators, but the risk they run, and you can see that yield curve has come down a lot, right? Because 2 years have gone up so much faster than 10 years, that if they continue to push short-term rates up, and are really kind of laser focused on fighting inflation at all costs, there's a chance they could push us into recession, right? Either way, though, we're already expecting more moderation, because even as prices have cooled down a little bit, they're only growing by 10%. With rates going up, the mortgage payment's still growing by more than 20%, right? So some folks will be priced out of the market. We do have a buyer fatigue problem, right? 16% of California consumers last month thought it was a good time to buy a home. And so we will have to start overcoming more objections and kind of like giving the old buck up, buckaroo speech, and showing some good data about the value of home ownership and the fact that rates and prices are still going up, because people have gotten a little bit scared. But I think the bigger issue, even than rising rates, is the supply issue, right? You can see that we've had 8 increases out of the last 9 weeks in terms of active inventory, but you can also see that we're still incredibly depressed, even by the standards of 2020 and 2021, which were themselves terrible years for housing inventory. And for me, this is why we're going to moderate down from those 15-year highs, is because you can't put buyers into homes that aren't for sale, right? And that's just a straight up fact. And that will, limit the number of transactions that we're going to see this year. That's especially true at the bottom end of the market. You can see that even that growth I just showed you in active listings, most of it's happening in the yellow and above, right? That's over 800,000. Under 800,000, the inventory story or picture or what have you hasn't changed very much over the course of the last 2 months. And we can actually go out and look at like how much can a person making $100,000 a year afford. If you do that calculation at current rates, it's about a $530,000 home, right? If you crunch the numbers and look at principal and interest and property tax, insurance, all that stuff, a $530,000 home at current rates gives you about $30,000 worth of annual payment burden, right? Which is about where we want you from an affordability standpoint. Well, we can go out and look at the MLS and say how many homes are for sale at or below that price point, right? And it's fallen from 40, 50,000 units that were affordable to somebody making 6 figures to now just 4,000 or so on the MLS last month. And just to put that into kind of stark relief, you've got about 4 million households in California that make between $75,000 and $150,000 a year. Even if less than half of those are in the housing market or whatever, or even a fraction, right? It's a huge difference than the 4,000 homes that are actually affordable. If you go back to the end of the last crisis, you're talking about over a third of people making $50,000 a year could actually afford, or people making $50,000 a year could actually afford a third of the listings, right? They can basically afford nothing today. But the really scary part is even people making 200 grand a year, who used to be able to afford 9 out of 10 listings, right, can now not afford 1 out of 3 listings, right? And that's pretty scary, because people making 200 grand a year, If you look at the kind of bell curve of incomes, right, they're pretty far out there, and 1/3 of listings for those folks are still out of reach. That's, I think, tells you everything you need to know about where we're at with affordability. I'll just touch on distressed inventory real quick because the number of forbearances has gone down dramatically, or the people who weren't paying mortgage payments, right? We were at almost 9%. At the height of this thing, it's, finished off at about 1% as the program itself closed out. But what's really encouraging is if you look at how those folks got out, right? 20% roughly went into forbearance, never even missed a payment and got out of forbearance, right? Another 11, 12% missed some payments, but have already paid them back. And if you look at all of these sources of folks getting out of forbearance, there's not a lot of systemic risk. So about 1% put it into their existing loan, maybe a couple $100 increase to their monthly mortgage payment, but a big chunk moved all the money to the end of their mortgage, right? So you're just going to make a few more payments in 2052 or whatever it is. That doesn't introduce a lot of systemic risk. About 15% actually modded it out. They just got a lower rate, stretched it out over 30 years. Again, minimal, sometimes no impact to their monthly mortgage payment. And some folks, about 7%, actually got into trouble, but because they had home equity and underwriting standards have been so high and we forced people to put money down, et cetera, we're able to sell that house completely, and in some cases even pocket money. So really, it's only about 17% of the folks that went into forbearance are truly problematic, that have either had a short sale or just have no plan in place and are sitting on a bunch of missed payments. And that, kind of maps with the delinquency data, where we have about 3% of mortgages that are delinquent in California after peaking at less than half of what they were 6 quarters ago. And we've been improving now for about a year and a half. In fact, California is in the top 5 states in terms of percentage of mortgages that are current, right? And so we're actually not just doing better than we were during the last crisis, we're actually holding up better than most other states, even though we went harder, faster, for longer. That's one of the beauty parts of having folks with a lot of home equity out there. So we'll see listings probably go up a little bit, but we're not going to have this big wave of foreclosures come in and save the day. I just want to get up on the soapbox for 2 more minutes before I leave and tell you, where this came from, and hopefully set up, Sanjay's stuff, because it's really very simple arithmetic here, right? We've gone from like 25, 27 million people a few decades ago to 40 million people. And we've gone from building 200,000-300,000 homes a year to building about 100,000 homes a year. And you really don't have to look much farther than that to explain the affordability challenges, right? It's not filling the pipeline with homes that can turn up as potential resales on the MLS. And therefore the homes that we do have out there, right, people hold on to for dear life. And you see that people are living in homes twice as long. And that is partly a function of that, right? You also see not only that we have less housing turnover, right, than the rest of the United States, but unlike the rest of the United States, turnover is increasing. Here, it's flat, right? Even with an improving economy, people don't move, right? And that is problematic for us as realtors, but it's also problematic for our clients. And that's why even with the lowest interest rates of all time, housing affordability was still declining. And now we're facing higher interest rates, right? And so that's going to be the kind of double whammy that we already talked about for housing affordability, which is already worse than the rest of the United States pretty much across the board. Yes, LA is in particular very egregiously unaffordable. But even, Riverside, San Bernardino counties, which are some of our most affordable markets, are far less affordable than most other parts of the United States, right? And so that is the challenge for home ownership, but it's also the challenge for our economy as well, right? Because now our population has shrunk for the first time in the 120 years that the census has been tracking California population. This housing affordability challenge is that kind of giant sucking sound that you hear pulling people out to, Texas, Nevada, Arizona. We had an acceleration of almost 300,000 people on net leave last year alone. And they're going to just basically 8 states, right? 97% of those out migrants over the last 15 years have gone to just 8 states. And they are either states that are very close by, very cheap, or both, right? And that's pretty much what it boils down to. If you look at the characteristics of those out migrants, if it was the high taxes that was driving everyone away, it would be the high income people leaving, right? But the vast majority are people making under $100,000 a year, which to me implicates housing in a pretty strong way. It wasn't until 2020, when people were allowed to work from home, that we saw some noticeable high income out migration. That has not been the scenario for the preceding 15 years. If you really want to see that it's a housing issue, you can look at it between what they do with housing when they leave, right? And that same 1.8 million people that left, roughly on net, 1.3 million of those, or 75% roughly, were people who left California and bought a home, right? And so to me, this is very much a housing story. Even though we do have high taxes and we are hostile to business activity and all of that stuff, people with high incomes can kind of afford to stomach the cost of doing business here and want to live in Newport Beach, et cetera, et cetera. It's the people who can't get home ownership that end up being forced to go live in Phoenix and things like that. So that, for all of those reasons, both the structural change where folks are, thinking about leaving, and the fact that we just don't have enough housing on the market, means that we're still going to have a foot on the grindstone, or nose to the grindstone, foot on the gas kind of approach to our business. Not because the market's going to go down. COVID is, those numbers have improved dramatically, and again, we have our arms wrapped around how to operate even if we do get another surge. We'll put the mask back on, and I don't think it's going to be a big hit to overall economic activity. We're also still optimistic about the number of transactions, right? We're still at a above those pre-pandemic levels, but we're just not at the kind of 10, 12, 15-year highs that we were at last year, because again, you just can't put buyers into homes that aren't actually for sale. For everybody who's fallen victim to the Kool-Aid effect and thinks that they're going to wait and save and all of that stuff, get them refocused on not trying to be a whiz bang real estate investor and perfectly time the market and buy low and sell high and do all that. No, you get into a home, you live in it, right? And you accumulate home equity, because when you look at the actual net worth of real families in America, this is, the one and only way that people have been proven to accumulate wealth, right? Renters in the latest Fed survey, right, still had the same $6,000 worth of net worth that they had 30, 40 years ago, right? They have not become better off. The reality is that when you don't buy a home, and people can show you a financial model where you kind of buy a bunch of stock and do this and that, and you can end up just as well off as you would have in a home, that never ends up happening, right? And the proof is in the pudding, and that renters don't accumulate wealth. They end up, living in a nicer apartment, having a nicer watch, driving a nicer car, doing all this stuff, and not doing all this kind of financial savant type investing, and really the key to getting you ahead in life. And not to get too mushy, but I'm the son of a guy who didn't even graduate high school, right? But he owned his own home, and that's I think the foundation that allowed me to be here giving this speech today. It's not that he was this kind of fancy economist with all these PhD buddies or anything like that, right? And so we need to talk buyers back into the game and get them focused on the long-term benefits, right, of home ownership, which is that intergenerational wealth creation. We need to convince sellers, hey, rates are going up. If you want to sell and buy something else, do it while rates are still low. And it's also still a great time to sell your home. As I showed you, 70% are still closing above asking price. Actually, in the local market, I think it was even higher than that, as I showed you. And so ultimately, I think we have a lot to be optimistic about, economically speaking, right? Jobs, the passion for home ownership, the benefits of home ownership, the fact that sellers will have no trouble selling their home this year. But on the other hand, we really need to get serious about the supply challenges, right? Because it's impacting the clientele with affordability and driving out migration. It's also affecting us as realtors, because on the buy side, we're having to work twice as hard, if not more, offer after offer after offer, and really just keeping folks head in the game and preventing them from getting that buyer fatigue, because there's just not enough listings to go around. And that makes it, even more difficult on the sell side, right? Is that we've got more realtors than ever before, less listings than ever before, and lots of buyers. And so when you put it all together, it means that yes, that kind of tide, that broader macroeconomic tide is rising, but that rising tide is only lifting some boats. And so you want to make sure you're one of those boats by, again, keeping your foot on the gas, not taking it for granted, taking that data-driven approach with your clients and getting them focused on what really matters. And so I think if you do that, the ingredients are there for you to have a great year. We have a forecast that's expected to grow in GDP, unemployment that will come down. California will continue to outperform the rest of the United States economically, and prices will continue to grow, but it's going to come at the cost of affordability, and we are facing higher rates. And I think that, together with the lack of inventory, means that we will see sales moderate from those 15-year highs to about 420,000 units, which is still a great number by the standards of the last 10 years. It's just not a cruise control number. So just keep your foot on the gas, and I think you'll have a great year. And with that, I will say thank you so much to John and Laura for having me, and thank you all for your time and attention.
Okay, Jordan, we have a few questions.
Awesome.
A couple of them are, yes, Jordan sent me his slides. So when we post this recording up on the education page of our website, the slides will be there for you to obtain as well.
Yeah.
We have a question from Larry Black. And if anyone has a question, they can raise their hand and I can unmute them so they can ask it themselves. But Larry wanted to know, do you have any data on the net discretionary income versus gross income based on the inflation and tax increases? Is it plus or minus?
It's still it's complicated. So, because if you're talking about gross income, then you're including transfers from government, which have, the kind of the siphon has been turned off on those, right? So we're not getting all those injections of new stimulus checks and all of that stuff. But if you factor those out and you look still after, netting out the inflation stuff, income is still growing, right? And so I think that, and that's a function of just more, aggregate numbers of workers being back to work. Even the average wage numbers are still going up, right? And I think those are moderately outpacing inflation. So even on like a per worker basis, we have seen, increases on the income front. And so there is real, honest to goodness improvement there. But Larry's point is very well taken, that the improvement is dramatically overstated if you're only looking at the nominal, unadjusted figures.
Okay. And then we have a couple questions about the first-time home buyers. I think you were saying that first-time home buyers were up. And I think that with housing prices so high and affordability so, unaffordable, that how is that even happening?
It was a lot of high income renters, right? That there was a lot of people in California that make, $150,000, $200,000 a year that were renting apartments in San Francisco. They were renting, studios in downtown LA and what have you, that now that they don't have to be at the office took, their high incomes and the fact that they didn't work in one of those industries that was negatively affected, right? The tech workers, the spreadsheet nerds, et cetera, that we could do these jobs remotely and, cut a lot of our monthly budget out of commuting costs and parking and et cetera, et cetera. And that, combined with the lowest rates of all time, motivated a lot of these high income renters into home ownership. It wasn't, unfortunately, a $50,000 a year scrap your way into the housing market kind of first-time home buyer. There was people who had big chunks of money to put down, either from their parents or because they worked in a company that IPO'd or what have you. But there's a lot of high-income jobs in California, and relative to the amount of supply that we have, there's there's still a lot of those potential buyers out there that pushed up the numbers. We're still nowhere near, and I think this kind of speaks to Lydia's question, is that the home ownership rate in California is still incredibly depressed relative to the rest of the United States, right? So it's still very much the case. And that's why I spent so much time belaboring the affordability, is because we don't have an environment where regular, quote unquote, people can buy homes, but we had a lot of irregularly high income people who didn't own before this that finally did.
Okay. And another part of her question was, do we have, and this may go towards Sanjay and maybe what he's saying, but do we have any responsibility towards these potential home buyers that are not in the higher income level, tech remote home buyers,
I think that like kind of underlies a lot of our public policy agenda, right? Is that a lot of these things, as I mentioned on the construction front and things like that, are structural issues that we can't just go out and flip a switch and all of a sudden have 80,000 homes on the MLS. We got to start rebuilding that pipeline. And I think that the motivation for us doing that, and why do realtors care about supply and stuff like that, is, because the stuff that impacts our clients impacts us, right? When people can't afford, en masse, and we can't get the 65-70% home ownership in the rest of the United States, it's bad for realtors because we don't have any more transactions than we were doing 30-40 years ago, even as the number of realtors is at an all-time high. But it also creates all of those economic challenges, right? And realtors also need just a growing economy and good jobs and stuff like that. And so, it hits us in the short run because people stay in those homes forever and we don't see them show up on the MLS. But then it also kind of stifles economic activity, which is another critical ingredient for the housing market. And so we definitely, I think, have a responsibility to try and get more and more folks, get that affordability number up so that more folks can get that dream of home ownership like my dad.
Yeah, I agree. We got about 3 or 4 more questions. Do you have numbers of new home sales versus the retail home sales?
We do get new home sales. I just don't track I don't track those as closely because the vast majority of those usually don't show up on the MLS. And so but we do kind of track all sales in aggregate, and we use those to like do our annual benchmarking and things like that. New home sales have been relatively strong compared to previous years, but we're also not building that many new homes, right? Last year we had like a 20% increase in building permits, and that was like 120,000 permits. So
For the whole state?
for the whole state, yeah.
Oh, wow.
Yeah.
Okay, what's your projection of property price changes by the end of 2022 as a result of the mortgage rate increases?
So we do have that taken some of the wind out of the sales of prices. We had almost a 20% increase in 2020, and then I think it was double digits last year, and we have that slowing to 5.2% this year. And part of that is because even with super tight supply, right, that higher rates will price some buyers out of the market, and that will probably result in less pressure on the median price. The other thing is we do see the market normalizing back from, we were selling so many $3, $4, $10 million homes at the onset of this crisis that because these are median prices, we lay out all of the transactions from the lowest price to the highest price. And then the median price is the one in the very middle. So when you do a bunch at the top end, then it tends to drag up that median. And so as we see the market, and I talked, kind of alluded to this a little bit, but with that normalization back to the kind of homegrown, inward focused buyer demand, that will probably mean we won't be as concentrated at the high end too. So prices are still going to go up, but probably by, low to mid single digits this year.
Okay. What, in your opinion, needs to happen to have some effect on the controlling the current raise in inflation?
Some of it's going to happen on its own, right? Some of it was supply chain focused, right? And as we start kind of flipping the sawmills back on, right, and start catching up with lumber orders and vehicle parts and circuit boards and chips and things like that coming in from China, et cetera, then that will mitigate. Some of it's already going away because a lot of it was car prices. Last year, I didn't bring this because I didn't know how much to keep beating you over the head with this esoteric macroeconomic data, but vehicle inflation was one of the primary sources of inflation last year. People took those stimulus checks and stuff and went out and bought new cars, and they'd been saving for a while. And new car prices were up like 25%, and used car prices went into the triple digits. And that has started to normalize. Car prices are car buyers are very sensitive to car prices. And when car prices double, then they decide to wait to get a car. But we are seeing wages rise, as Larry asked about. And I think that, is going to be one of the things that we have to put a TBD on, right? Is just how much this crisis really changed the dynamics of the labor market. People who said, I'm never going to work again and I'm moving to wherever, right, and doing all of that stuff, that has put the workers who want a job kind of in the driver's seat for the first time in a very long time. And anybody who's tried to fill positions will be able to tell that. But if we go into a recession, right, how strong of a bargaining position I think our workers going to feel? Maybe not as much, right? When people are shedding jobs and not looking for anybody to fill jobs, then you don't negotiate as hard, right? You're like happy to take what you can get. So I think that higher rates will help. I think some of it was transitory, but I think a big part we'll have to see what the labor market does, right? And do more workers really, realize they didn't have as much money in their savings account as they thought and start coming back to work.
Okay. Where do you see the rental market going in the near future with the moratorium hopefully phasing out?
Up. I think that it's the same, it's analogous. They're substitute goods in a way, right? If the rental market was going the complete opposite direction of the housing market and it was becoming cheaper and cheaper, then you'd see a lot of people start to rent. But the rents, the vacancies, they're all symptomatic of the supply issue. And I think that you might see some investors decide that prices have risen enough and they've made a good return on their investment with all the hostility towards landlords and stuff that they'll dump it. But, the population is still huge and there's still not enough houses out there for folks, whether you own or rent or whatever. And to me, that suggests higher prices and higher rents. And so I think it's still a good time to, own rental property. And I think, in the same way that it's still a good reason to own your own home, right? Is because the equity is going to keep accumulating.
Okay. Let's see. I think I have two more questions. In your local market, is the local market mostly outperforming statewide average? Is the percent based on the money amount or the number of transactions?
Those were number of transactions. So
Okay.
Yeah.
Okay.
If I put the money in there, then we'd be seeing the effect that Larry mentioned, right? Where volume would be going up like 40 and 50% because we're having 20% increase in price on top of 10% increase in transactions. But those are like real honest to goodness people getting homes.
Yeah. So here's a question. I'm not sure how you can answer it, but what is your advice to a retiree with rental properties that the higher interest rate almost doubled? Should the answer is to sell even though the price is not as high as when the property was bought?
If you're underwater on a rental property, I would ride it out. Honestly, I think prices will go back up. Like people who got spooked in 2006 and dumped their house in San Francisco at $1 million are looking at $2.2 million median prices in San Francisco today and wishing they would have held on.
Yeah. Okay, one last question from Sharon. Is your local market mostly outperforming statewide average? No, I think we did that one already. Yeah. I think we're done.
All right.
Okay.
Great questions. Thank you so much.
Yeah. Okay. John.
All right. Thank you so much, Jordan. I just wanted to remind everybody to make sure that your question is seen. Please throw it into the Q&A app if you can. We are seeing them in the chat, but please throw them in. And just a reminder to anybody who came in late, we are going to be hosting this presentation later on our website and YouTube. So keep an eye out for that. So next we have our legislative update by CAR Sanjay Waggle. Sanjay is the Senior Vice President of Governmental Affairs at CAR in Sacramento, and he lobbies on behalf of associations and supervises the work of CAR's policy staff. I refer to him as the guy everybody wants to call in CAR director meetings because he actually can give us the dirt on what's going on. And prior to working with CAR in government affairs, he was with CAR Legal. He's actually been with CAR since 2003. He received his law degree from USC, his MA from UCLA, and his BA from University of Chicago. So I know we're all kind of curious at some point, though it's not the most important question, Sanjay, Trojans or Bruins? Since you got a stake in both. And he's going to be talking to us today about the legislative issues and agenda for 2022. So Sanjay, thank you for being with us today.
Thank you. And I'm pretty much just going to go ahead and talk about some of the big legislative issues that you're facing and that you can look forward to maybe hearing about from us in the near term. So I'm going to just briefly talk about the overall political environment in California. As you know, this is a redistricting year. This is an election year, and that has certain consequences for how the legislature is going to be acting and what our challenges this year. So first of all, while there's obviously going to be a lot of movement, there's a whole lot of people who are not coming back. There are some people who are being termed out. But frankly, the overall numbers and picture of the political situation in California is unlikely to change. So, it is still likely that all executive offices will be held by Democrats. The supermajority is almost, you always want to put, we live in a very uncertain time. So I all sorts of things keep happening. So I'm always hesitant to say, this is going to happen. But it's very likely, based on current polling, et cetera, that the supermajority is also going to extend and actually possibly even get bigger in the assembly. Current projections of polling we've seen suggest it might go from 60 to 63 Democrat to 17 Republicans. That, again, things could change, but the overall legislative environment is not likely to change in California. However, so I'm just going to go over some of the challenging bills that we have this year and also talk about that to some extent within the political context. Taxes. So I'm going to start with taxes to talk about legislative issues, but also an initiative that's going to be getting on the ballot as well, or is likely to be on the ballot and will be considered at our upcoming Board of Directors meeting. So a bill, AB 1771, is getting a lot of media attention right now. And I've been getting calls from a lot of GADs, AEs, individual realtors. This is the quote unquote, it's officially called the anti-speculation bill, but really we like to think of it as an anti-property ownership, anti-home ownership bill, which is a more accurate characterization. This is the bill that would impose a quote unquote speculative tax on properties that are held for less than 7 years, with that tax being up to 25% of the gain in the first 3 years. That does apply to homeowners, not to, if it's your very, very first home and you've never owned a home before, it doesn't apply to that owner if that remains owner occupied. But let's say you buy a second home, and I don't mean a second home, but sequentially a second home at some point, that would apply to you. And all other property. Jordan's shaking his head because so let me be very clear. We oppose this. So I've been getting questions. Where was CAR on this? Was there a question? We oppose this. We oppose it, and we're not opposed unless amended. Oh, if they change this, maybe we can live with it. We're just opposed. Okay, so it's a straight oppose. There's nothing to do to fix this bill. It's just bad. So we are opposing this bill. And it's really concerning because it's a strange bill to, the rationale behind it is, to me, very problematic in many ways. But yeah, we are a straight oppose on this bill. We feel now, since it is a tax, it does require 2/3. This is an election year. In general, politicians are not keen about voting for taxes in an election year, okay? So this is probably not, I think it's going to be very challenging for the author to be able to move this forward. I wouldn't be surprised to see amendments. He might try to amend the bill to try to make it more palatable, maybe. But I think just the overall numbers, the overall structure of this bill is very, very harmful. And one of the arguments, which, by the way, we're making, and it may seem sort of counterintuitive, but is actually a very strong equity argument about how unfair this bill is, which is that if you're a long-term owner in California, you're not touched by this bill, right? But in the recent past, in the recent years, California basically is a different state in many ways, demographically speaking. It's a far more diverse state. So all of a sudden, as you have this more diverse body of people entering the housing markets, you're cutting that. They no longer get the opportunity, right, to make a decision. Like, oh, the market's really up, and maybe in 2 years, the market's changed a lot, right? Maybe I'll sell and maybe I'll do some investing, or I'll save, I'll come back. No, that's all gone from you. Those are opportunities for intergenerational wealth building, for the security that comes from home ownership, the investment opportunities is all being stripped away from new people, which is just perverse and doesn't actually make any sense. The other thing is it doesn't create any exceptions to anything. So let's say you buy a home and, oh, lo and behold, your family's now getting bigger and you want to move. You have a job change. Somebody gets ill and you need to move. Too bad. You now have to pay a 25% tax. there's all sorts of complications which have not been addressed or thought about. What if it's a married couple that owns a home, one of whom owned a home before and one of whom didn't, right? It's a mess. We oppose. We are going to be sharing soon. Just to give you all a heads up, we have a new member, Mobe, Matt Bunch, who's our new member, Mobe. We are going to be working on social media posts and stuff that you will be able to share, that members will be able to share on their social media platforms, also to maybe get your clients aware of this, so that everybody's aware of this and make sure and clear that this sort of bill is just not acceptable. Okay, so that's wanted to get that out. So that's AB 1771. The second in that vein that I wanted to talk about is there's also going to be, for consideration at our board of directors at the next set of business meetings, an initiative that is sponsored, I believe it's by the California Business Roundtable. For those of you who, just a quick refresher, for initiatives, the CAR board of directors can consider a position on an initiative that is real estate related once it has attained 25% of its signatures. Once it fully qualifies, there is a position taken on all initiatives. And that position could be not real estate related or a neutral position. But at the 25% mark, if it's real estate related, we will bring it to board of directors for consideration for a position. So one initiative has hit the 25% mark, and it's actually takes care of some things that arose out of our recent court case. Most people had thought that for special taxes, you needed a 2/3 vote of the people in order to have a special tax imposed on a local level. The Supreme Court in California recently said, that's true if the city government or a government entity puts it on the ballot, but if it's done by initiative, no, you just need a simple majority. So there's been a big change now. All these groups have thought, oh, so we can get taxes passed with a simple majority as long as we just do it through initiative. That opens up a big door, and we're seeing all these moves on the local level to potentially to do initiatives to raise taxes. We do not like that. I don't know where our board of directors is going to land on this initiative, but this initiative basically would return everything to a 2/3 vote for these types of special taxes. It would also require voter approval of, it would restrict certain types of parcel taxes as well, and would also require the government to indicate what the special tax is in fact going for and how it's going to be spent. So this initiative will be taken to our board of directors for consideration. The position could be simply to wait until it qualifies. But at this point, that's the only one. You may be hearing in the news or in social media or other sources about other initiatives, some of which impact tax, et cetera, but none of them have hit that number. Just to let you know, one of the things that's going to impact the ability of initiatives to get to the ballot is it's very costly this year to get initiatives on the ballot. As you can imagine, labor shortage issues, at least until recently, the COVID situation has made signature gathering very complicated. And by that, I mean very expensive. So gathering signatures is extremely expensive. And so initiatives are faced with making a big decision about how much they're willing to spend upfront just to gather signatures. So those are two in the tax front. Again, in terms of other legislation that might come forward in the tax front, I think in general, we're going to have a pretty good year there in being able to oppose it. Frankly, again, a lot of this has to do with an election year. And I'm sorry, the other big issue is we have a huge surplus. California surplus keeps getting bigger and bigger. And so that also makes it very, very difficult for tax. And I think I've talked about in the past, the personnel that are on various committees is very important in terms of what advances in terms of bills and how those advance. The chair of Assembly Revenue Taxation is a very moderate Democrat, Jackie Irwin. So we're expecting a very fair hearing in that committee. So the next issue, which tends to be of importance to everybody, is of course landlord-tenant. We have a series of bad bills pending in that, many of which we will have to oppose. A lot of those, one of the worst bills is going away, which would have forbidden the consideration of any credit history when you're renting out a unit. That bill is gone. There are some proposals that would limit the ability to look at credit reports for government subsidized tenants, Section 8. We are opposing those. So that just be aware that those are things that would impact a landlord's ability to look at credit. Our strongest oppose in this area is AB 2469, which is a bill that would establish a statewide rental registry. That's a strong oppose for us, that it is requiring the disclosure of an incredible amount of information that would be kept regarding landlords and property owners. It does nothing. It's a very expensive program, which would do actually nothing to give further protection to tenants or even create a stick of housing or anything. It really just is a big, gathering of information regarding landlords for no good reason, and a very costly one at that. Finally, they're calling it a cleanup bill, but it is not. It is meaning a cleanup of the rent cap bill. What it would do is actually further expand some of the rent cap provisions and make it actually even harder to evict people or to terminate tenancies, even if they're bad actors. So we are strongly, so far, opposed to that. Laura, you mentioned briefly the extension of the rent moratorium. That is something we are watching very carefully. We don't know, we have not yet heard of, but these things can move very quickly. The legislature can move a special bill, governor could sign an extension, which is similar to what happened last time. We have recently heard, and this may or may not surprise you, that the California Apartment Association is actually asking for an extension of the moratorium. So they believe that it is better that law continue because it preempts stricter local ordinances in that space, and that it will continue the various programs to help landlords get assistance. So they believe, taken as a whole, it's better that the state extend the moratorium. We are going to have discussions with them as to what is the, maybe they're, and we'll talk to our locals about, are they seeing things which really does look like it's going to be much worse on the ground if this law goes away, et cetera. We've got to look at it, but we were a little surprised. It's one thing to maybe go okay, there's nothing we can do, but they're actually asking for it. So that's a very different scenario. So that's something we're going to have to see what they're proposing and what's going on there. But just to be aware, there's nothing formally out there on the moratorium about extending it. I honestly think in general, there would be a reluctance to do so. It's kind of a mixed bag because locals are, I'm seeing in there about how LA County has various moratoriums and various areas have them, but they're somewhat constrained by the state law in their provisions. Once the state law goes away, it would lift some of the constraints on those local moratoriums. And so that is something we're just going to have to look at, is how does it work on balance? And so those are, again, the challenges in the landlord context. And politically, let me just give you some of the concerns we have about the landlord tenant bills and opposing these. Now, we're going to oppose most of these because it's just, there's nothing in there that's good for us or good for housing providers. But you are going to have, I think, some members of the legislature who might be with us on a lot of issues, balancing where do they vote on some of these issues. A lot of moderate Democrats in certain areas are actually seeing challenges from far more left-leaning Democrats. And so they might have to feel that they need to vote for certain of these provisions that are relevant to their people in order to fend off some of those challenges. So we'll have to see, even if they don't think it's a good idea. So we're going to have to see what happens in that case. But I think some of these, like the statewide rental registry, which do really nothing to help the actual tenant, we should hopefully be able to move forward on those. We are also going to be seeing, we had a very successful effort on beating back the Ellis Act. That only applies to those of you in rent control jurisdictions, but it's frankly just important as a matter of property rights. That's the bill, that's the law that protects a owner of property in a rent control jurisdiction to get out of the business of renting property. As we've said before, it seems so odd that you have to have a law that says you're allowed to stop doing something. It would be, the analogy I always use is, could you imagine if Safeway was having trouble making money on a given store and the government said, whoa, stop, you got to stay in business. Too bad, stay in business for 5 more years. We don't care. That would never happen. And yet that's what this law, if we didn't have the Ellis Act, the government would actually do to people. So that's going to come back again, and we are going to be opposing that. We have some bills in the transactional space, which we're a little concerned about, which are point of sales around swimming pools, but the authors have promised to work with us to address those concerns. So we're pretty optimistic there. So those are, again, the big areas. There another bill we're opposing, but again, I don't think we're especially necessarily concerned about because it's just so poorly done as a bill, is a bill that would create what's called the Social Housing Act. It would basically be the government going back into the business of owning property and renting homes and doing all that, and at an incredible cost, and a new agency, and all. It's just mind-boggling because you think how much money is going to be spent on creating a new agency rather than, for example, having tax credits or incentives to simply build this type of housing, right? So we will strongly oppose that. I think the fiscal numbers on that are going to be crazy, but that bill I'm going to mention is a good indication of a trend we've seen, and they were going to try this on single payer, which is a strange trend, and we'll see if it continues, where you pass a bill with a majority vote. So in this case, let's say you pass the social housing bill where they say, yes, the state will buy housing. That's it. But then you have to have money, right, to do that. Then they do that as a separate bill, and that is a 2/3 bill, right? But it used to be that you would do that all together, but they're trying to get the concept in and then try to do the financing. It's a trend we've seen. It's what they tried on single payer as well, but obviously we're not successful. We have our two sponsored bills, and these go to, Jordan mentioned the issue of supply. We continue to push supply as much as possible. After the big supply bills of last year, SB 9 and 10, there's probably, to be frank, there's not much of a stomach for like aggressive supply bills. We are moving two bills, though, which we believe are going to be helpful for home ownership. One of which is an anti-bulk sale bill, which we're currently working through with the consultant, which would be, after the last foreclosure crisis, you had very large corporations buying mass amounts of foreclosed homes. And at the time, actually, we and probably everybody was okay with that. There was a credit crunch. There was no ability to buy homes, so it helped bring stability to the market, helped bring stability to the areas. But at that time, nobody was thinking, oh, they're just going to hold these forever. It's not, they're going to slowly get rid of these homes. And so think about the equity growth that has happened since the foreclosure crisis to now. Instead of accruing to homeowners, especially this generally happened in areas which were more affordable areas, the mass foreclosures, that's accrued basically to large corporations, right? This equity growth has not gone to individuals. To help prevent that from happening in the future, this would require a first look program, similar to what the federal government already has, but that would be put into California law that would require a first look to homeowners and nonprofit to look at any home that's foreclosed upon by a federally regulated lender. We also have a bill that will, and we are also working on the budget to try to get a greater allocation of money toward home ownership housing. Currently, a lot of the home ownership money is all going to rental housing and not home ownership. So we are trying to get a stronger allocation both within the budget process and of federal monies that come into California to go to home ownership housing. We are working in coalition with not just the builders, but we are working in coalition with Habitat for Humanity. So these are aiming to get into those sort of more affordable homes, but home ownership, right? Not just rental where people are forever in renters and you don't have the equity opportunities and the intergenerational wealth opportunities that you have had before. So that's currently where we are legislatively at this point in time, but I wanted to sort of talk generally about mobilization and activity. The last 2 years, we've been able to do a lot without doing formal broad red alerts, right? We've been able to through the lobbying process, through the efforts of our key contacts, which are, if you're not familiar, are members who have good relationships with specific members and who can convey our concerns to them. That's been our main source of activity. We did one of our first red alerts recently against the Ellis bill, but these are targeted red alerts, right? We're not doing the whole state, because if you're in an area where you have a member who it's a lost cause, we're not going to do it, or you're with us. So, well, there's no reason to bother you just because you're already with us. But we are red alerting members who are often on the line or who maybe really need to hear from us and might change their vote potentially once they hear the real concerns. I suspect you might get some more of these. So please be aware, because our strength really is in the fact that people respond to these, that the members see like, wow, okay, there's a lot of people out there who are really worked up about this. So it's very, very important that if you do get red alerts from us, to respond. We're going to be doing a much more coordinated effort we have now a more sort of reinvigorated local government liaison system. Our member Mobe is going to be more focused on all these things in a beginning way. That's what I mean. Like even on that tax bill, you're likely to start getting materials that you'll be able to distribute to get these messages out. So it's going to be very important, because in a lot of these things, we're really fighting to get basic things across, right? That home ownership is important, that we can't be a renter world. You've got these groups in Sacramento. They don't have traction yet, but they're pushing, right? They're pushing to say home ownership isn't that important. We just need more rental housing. And as long as there's stable rental housing, why do you need homes? There really is this small faction of extreme views out there. And again, they're not a majority view, but it's out there, and it's stuff we have to work on, and we have to work on to defeat. And going to back what Jordan was saying about our overall numbers, that's one of the concerns, right? Is increasingly as more and more people, and why we're pushing for greater allocations of money for middle income homes and affordable housing, and for more housing at every level, because that way more basic economics is, if you have more and more people who think I can never own a home, right, then home ownership as a principle starts to lose its importance to people, because it just becomes this abstract thing that isn't for them. And that would be a real problem. And so right now we're still at about, I think, 56% home ownership. Is that right, Jordan? So we're still in the majority, but any of you, I'm trying to think in your area, maybe Pomona, I'm not sure if you have any renter majority cities, but if you are, you see what happens in cities where the rental majority becomes significant, 60 to 70, automatically you start to get policies which are not as favorable to homeowners. So that's something we've got to be very, very cautious about, is making that home ownership dream very much a reality for everybody. And that does mean more supply, which also means some hard choices in terms of supply as well. So that's all I have for you today. And I'm happy to take any questions.
Okay, let me see what kind of questions I have. And then is Tim on here? Tim, are you with us? Okay, is there a place that we can go to online to find all these bills, names, titles, etc.?
Yes, actually what I'll do after this, Laura, if you don't mind, I'll just forward you a list of what I talked about, but I'll also send you a link to that.
Okay.
Because a lot of these, and just to FYI, while we did a bill introduction deadline about 2 weeks ago, a lot of these bills are actually, like that bill I mentioned, AB 1771, which is the that tax bill, that had been introduced as something else entirely. There's a process which feels like shenanigans if you're not in Sacramento, where technically you're supposed to introduce all the bills by the bill deadline. But if you just introduce a bill, you can sort of just completely amend it into something else right after, and that's what happened with that tax bill. So yes, I'll be happy to put together something.
Okay, and then what was the bill title for the clean rent cap bill? What was that one? Clean up rent cap?
Yes.
Bill?
1 moment. That is AB 2713. Hold on, I'll put it in chat.
AB 2713.
Correct, from Wix. And that's technically, they're calling it cleanup, but it goes way beyond cleanup. It's a significant attempt to expand that law.
Okay.
We did a cleanup, by the way, last year, which, just kind of takes a true cleanup bill is, oh, that word shouldn't be there. Oh, that created a little confusion in the definition. Okay, that's cleanup. Cleanup is not sort of changing and expanding a law.
Okay. Christine, I unmuted you if you want to add anything.
Oh, I think you all do a great job. I think what Sanjay highlighted, and we've still gotten quite a bit of feedback or inquiries about the LA County moratorium. Again, that was extended through the end of the year with certain provisions through June 1st of this year. And primarily if a house is sold after June 30th, 2021, so of last year through June 30th of this year, you can't, if it's intended to sell during that period of time, you can't evict someone for the purposes of selling the property or owner move in to sell the property. Basically, for the last year, there's a moratorium on even single property owners evicting a tenant for the purposes of selling the property based on that local moratorium, which again affects all 88 cities within the county, not just unincorporated county.
Actually, that's an interesting. So the local ordinance prohibits that. Now, we'll have to. I might talk to.
I'll forward that to Sanjay, but yes, that is it's a big deal. There's no question. And basically, they wrote into the resolution, which they've amended 20 different times, which. Right. And no legislation should be amended that many times or extended or modified. But you can add in as many tenants as you want, basically, and you can't evict someone for pets or again, other habitability issues given the pandemic. But I will send that to Sanjay. But yes,
we'll actually raise that because again, we're going to be entering into some discussions with the apartment association to kind of see, to see, sort of get the rationale for asking for an extension. Because it looks like the locals are kind of going wild anyways. So how much does the state really constrain that? So that's something we're gonna, as I said, we want to have a conversation with them and see what's behind this.
And the other,
or just to understand where they're coming from.
The other item it was, and Jordan brought this up, and someone had asked about inventory. California HCD has come out with a statewide housing plan dashboard that is available. It compiles all data throughout the different counties and also provides status updates on the housing elements, which Sanjay could touch on. But within the SCAG region, which encompasses 6 counties and 197 jurisdictions, I believe last month only 2 of the 197 had a housing element that was approved by HCD.
And one thing which is happening in terms of housing element and local government's responsibility to plan for and provide that housing is the state is actually getting much more aggressive about suing. And the Attorney General's office is going after cities and counties that do not comply. So there is much more of an aggressive effort. And I think many of you might be aware of our own legal foundation has also been a participant in many of these lawsuits and has sued. Our legal foundation has had frankly, a really good track record, especially in the ADU context, in terms of getting cities to comply with the law. So we've been working in complement basically with a lot of the state actions as well.
Don, do you have anything to add?
Well, just, so my question would be more around, we've got, as you were saying, this super majority that tends anti-home ownership, my words, but what I would want to know is, so given that feels pretty monolithic to realtors on the street, how would you recommend that we get involved as voters, as just realtors? What are some of the things that we can be doing that are within our reach and possibly where we can actually see a lot more traction?
Well, to be fair, John, I wouldn't say that the supermajority as a whole is anti-home ownership. I think you've got a very vocal and loud, small contingent that is, but they're loud. And so to some extent, I think it is really, depending on your member on these issues in your area, is to really make it clear, hey, this is important to us, and these issues are important to us, and make your voices heard, especially with your state representatives, but also frankly on the local level, because looking for the future, those are the people who become your state representatives. right? And that's why we're making much more of an effort on the local level, is to make it clear that, hey, these issues matter, so that as they move up to the letter, that they understand these issues from the get-go. And when I say it's a small number, it's because, but they're vocal. And for reasons, I'm a Southern Californian, so something that always sort of irks me is that a lot of those loud voices are all from the Bay Area, right? It really is much louder from there. And for some reason, they do carry, they're loud, and they seem to be especially loud in Sacramento, more so than sometimes I feel the voices from down here. I mean, from the LA area. No, so to me, the main thing is to really support those members when they are on our side, and to make sure that voice is heard. For business groups like ourselves, frankly, there is significant enough moderate, what we would call the moderate Democrats, and with moderate Republicans, it combined on certain issues that can make a big difference. Like the Ellis Act is a perfect example. When we were able to put, even though they claim otherwise, we were able to, that didn't even go to a vote. And remember, all they needed was 41 in the assembly, where they've got 60 votes, right? It's true, there was a lot of absences, and those count for us in a way, but they couldn't even get enough votes to feel comfortable to bring it to a vote, right? And why is that? Because enough people were convinced this is not a good idea, right? That you spoke, that members speak, that they get it clear to the members that, wait a minute, this is bad. And I think it's really just a question of being active, responding to our calls for action, responding to red alerts, but especially as far as the long game is getting involved on the local level. It really is important. And we're going to be doing more efforts to get people on board. But frankly, going to that city council meeting, being the voice, other groups, they go, right? There are certain groups that they make that effort. They show up at that city council meeting. And don't get me wrong, a lot of realtors do, but we've got to get more voices out there that go consistently, that are always voicing those views, making it clear. Because one thing that's shifted, for example, in the home ownership context, and which has been a very useful one, is this notion that Jordan's talked about, is that this is the way that ordinary people accomplish some, are able to put together some wealth in this country. And so, like, for example, this fair housing discussion, it's sort of tuning into people like, oh, you've got these big discrepancies in wealth in this state, and they're getting worse, right? In terms of inequality on wealth, like, well, how do we remedy that? Well, you're not going to remedy that by having people be renters for their whole lives, right? The way it is home ownership, and that's getting traction. That's getting traction even among what you might perceive as much more sort of, maybe historically more sort of quote unquote liberal group. That's getting traction. On the federal level, it's got total traction. Like the Congress, I was just recently on a DC, that has total traction among what you might want to call the more progressive or Democrat established, congressional people. They're all in on home ownership as the way to help address this income situation. So we've got to, meaning this sort of discrepancies in wealth that are happening. So we've got to build that message even further. So again, I'm going on and on, but get involved, especially with your locals.
All right.
I think that's an important
and get involved means going to the city council. It doesn't mean like on Facebook. Okay, just to be clear, I hate to say it, but I feel that's been a problem. People feel like I've done something. I said that stuff, that stinks on Facebook. I'm done. No.
And I've seen too, like when I go out and do local outreaches and stuff, like sometimes you even meet like city council members and stuff. They like want to approve housing and stuff, but then they're not being supported for that. Then you're just asking them to stick their neck out for no reason, and so they got to be supported to make the right choice too.
And I think you have a great point, Sanjay, because I've seen some of our local city councils who have been against building homes in their area, and we need more homes is the bottom line.
Yeah. You need a bit more homes. And again, I think especially depending, and you have to sort of, look at who are the parties and the politics. But I mean, again, I think with certain groups that maybe might be like, oh, well, rental, we need more rental. You can say, well, you know what, you're relegating then a whole population to never being able to move up, right? You're basically saying to these people, those opportunities that all these generations of Californians have had and enjoyed and are now appreciating, it's not for them, So,
Yeah.
I mean, I think that does get traction.
Yeah. Okay, Lydia. You want to ask you have to unmute yourself.
Where am I?
There you are.
No, I mean, where are you on questions? I can't see where you are.
I don't know. You had your hand up, so I called
Oh,
on
I'm
you.
sorry. I didn't mean to put my hand up. I meant
Okay.
to face.
Okay. Do you want to ask a question or no?
I have a bunch of things here. But he already answered about the repost, about posting the bills.
Okay.
Yeah. And the other one,
Okay.
I just said, thank you, Sanjay. That
Okay.
inspired me to get involved. That's
Thanks,
all.
Yay.
Lydia. Great.
Okay. Does anybody else have anything?
Nothing's more convincing to a city council meeting than seeing a bunch of new faces. So keep that in mind.
Okay.
All right.
Yeah.
Well, everybody, thank you. Thank you so much for being here. Thank you, Jordan. Thank you, Sanjay. It's been wonderful having you here. Thank you for all that you're doing and for the resources. And it looks like the most common request we're getting, or one of the most common, is for just where they can access these resources after to dive deeper. So I'm sure, Laura, we're going to be able to hand that out to the membership later on.
Well, Christine's put quite a few of it in the chat, and yeah, we can put that. We can put these links on our government affairs page on our website so that people can go get them whenever they need them. And John, I don't know if you can see the chat, but Sandy just asked a question if you want to.
Are there any bills helping commercial landlords presently?
At this point, there is nothing pending. Either way, in terms of the commercial, yeah, nothing yet.
Are we getting more buy-in from commercial brokers on our efforts? I mean, are we seeing that more? Because I know that we've always kind of had somewhat of a parallel track with them. Are we seeing more yet?
There's a degree of especially during the pandemic, there were certain bills that were very concerning to them as well. And so we were able to, we've been working a little more on some of these, what I would call more business related issues. Yeah, so we have a good relationship with the California Business Properties, who's the group that represented the commercial interests. Yeah, and we've been building that a little more because, again, during the pandemic, there are some bills which would have affected them and us. So we started to see a little more commonality of interest.
Okay. All right. Well, again, thank you to all of you. And we hope to see you, hope to have you guys here again.
Thank you,
Thank you so much.
everyone.
All right.
Bye.